Welcome back to the channel. Thank you for tuning in. So this is gonna be how to trade the New York session part 2. So in this video, I'll be showing you how to trade the New York session using, how to trade Nasdaq during the ICT New York Killzone. So when we're trading Nasdaq, we'll be looking at 8:30 a.m. and 11 and 12 a.m. for Nasdaq. So with Nasdaq, we can with Nasdaq the New York session ends up to 12. So guys, I'll be looking at the futures contract of Nasdaq since I'm bank testing, so it doesn't matter if it's delayed. So when I'm using the futures contract, guys, I like to be on regular trading hours. As you can see, if I put electronic trading hours, we have a normal chart that you get on TradingView. I want to show you this. So as you can see, we know the London session is from uh, 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 so we know the London kill zone is from 2 a.m. up to 5 a.m. So when I'm on regular trading hours, it hides all that London trading and the Asia trading as well. So it only shows me price action of the New York session from the previous day. It closes at 16:15. Then the very next candle is the following candle at 9:30. Is the opening price at 9:30. So just be aware of that. When I'm on regular trading hours, I'm only looking at the New York session. It closed, and when it closes, there's no movement. Then the next candle opens at 9:30 the following day. So because of this, it means our opening price of the New York session is somewhere in the gap. But that doesn't matter. I already put the end of our New York kill zone. I already put the end of our New York kill zone. So we'll only be looking at this price action here. This is the New York AM session. So to begin with, every day when you open at 9:30, you always have a gap. So what I like to do is that gap, which is an imbalance in price, you take the Fibonacci and you measure 50% of that gap. Okay, let me just remove this extra lines, but I draw your attention to one specific point. So this 50%, we call that a quantitative encouragement. Is the midpoint, the 50% of a gap. It's called quantitative encouragement. So this gap, that we call that the opening range gap. No. It's a new day opening gap. It's a new day opening gap. The name doesn't really matter. The most important thing to take away is this is a gap. Now, the midpoint of a gap is called the quantitative encouragement, CE. So we can see price trading at the opening there, the opening candle, as soon as it opened at 9:30. The next one, price draws to the quantitative encouragement. It taps it. Look at the bodies closing above, and then it starts breaking high, offering higher prices for throughout the whole day, basically. So just take note of that. So price will always find a way to trade most of the time with the 50% of the gap. So let's say you wanna trade this, you wanna trade the New York AM session, ne? You wanna trade the kill zone basically. Once you see price finding support there and then breaking higher, we have a swing high here. In other words, we have a high which has a lower high to the left and a lower high to the right. When that gets taken out, that's a market structure shift. Bullish. So that's a bullish, I'm just gonna say bullish market structure shift. Ne? Sometimes you see some smart money traders put a candle. So candle, that's a market structure shift, right? So when that happens, we look for a fair value gap. So in this displacement leg, you can see we take out this swing high, we take out that swing high, and we take out that high as well. The market structure shift happened as soon as we take out the first swing high. So we look for a fair value gap. Then you can see we have a fair value gap here. It gets, let me just extend it to the right a bit. So we have a fair value gap here. It gets traded to the first time. The bodies are still staying above, as you can see. And then at 10 a.m., it's 10:07, it starts breaking lower into the fair value gap one more time. Again, I told you about the 50% of a gap. A fair value gap is also a gap. So that 50% is there. And then you can see price finding support there. Look at the body staying above. So if you wanna know how to trade that, as soon as price comes back to the fair value gap the first time, you can buy that. Some smart money traders, they will wait for the 50%. So as soon as it touches the 50%, you can buy that. It goes up, comes back, gives you a second chance to buy again. You can buy that. So this is the fair value gap consequent encouragement, the 50% level there. Okay, let me just quickly use an entry tool. So you can buy the first time at the consequent encouragement, in other words, the midpoint, stop loss below the candle that creates the fair value gap. Stop loss below that. Then you look at the drawn liquidity. So we have a high here that was made yesterday. So this high, there's buy stops above this high. So you're gonna use this high as a draw on liquidity. In other words, we know the market has to go up there to collect the liquidity. So as soon as it takes up the high there, you can exit. You don't need to hold any further, to be honest. What time is that? So at 10:38, that's even before your New York kill zone ends. You could have met your target, and then you don't really have to trade for the day, do you?